In this video, I will be talking about quantitative easing, tapering and its effects, and what should investors do to prepare for a taper tantrum. A strong economy implies a high rate of economic growth. This means an expansion in economic output, which will lead to higher average incomes, higher output, and higher expenditure. But during COVID, the world is under lockdown. Businesses closed, many events got cancelled, and people lost their jobs. The economy is in bad shape. Think about it. If you don't have a job, you don't have an income. If you don't have any income, you can't buy anything. And if you cannot buy anything, business can't sell. And if they can't sell anything, they will close. And no one wants to open any new businesses because no one can buy them. Money is not moving through the economy. And if this bad cycle continues, you can see how problematic this can be. In response to this economic downturn, two of the major policies the Fed implemented to stimulate the economy were lowering the interest rates and ramping up quantitative easing. They want to encourage lending and spending, and hopefully it could lead to more business activities and keep money moving through the economy. It's quite easy to understand that when the interest rate is low, it's cheaper for you to buy a house or car. Lower interest rates have worked for many developed countries, but there's a limit on how much the interest rates can go down. In December 2018, the interest rate was 2.25%, but the Federal Reserve lowered its target at a range of 0% to 0.25% on July 28, 2021. So, with little room to lower the interest rates further, quantitative easing was implemented to stimulate the economy. Quantitative easing, or known as QE, is a form of monetary policy in which the central bank buys longer-term securities from the open market, which means the other banks, in order to increase the money supply and encourage lending and spending. It is a tool used by central banks to provide liquidity to financial markets and keep money moving through the economy. The essential goal of QE is to lower yield, and this makes borrowing for businesses cheaper and ideally boosting the economy. To simply put it, during COVID, a lot of companies went out of business, and it was risky to start a business, and the banks were reluctant to lend because they were afraid that borrowers couldn't pay them back. So when the Fed implemented QE, which is to buy these longer-term securities from the banks, which would increase the amount of money held by the banks. And by having more money sitting there, making very little return, the government is hoping that banks would be more willing to lend out to businesses and consumers. And there were other banks competing with each other, and the more money and the more banks to lend, and ideally, they would compete with each other to lower the interest rates and make it easier for people to borrow and spend, eventually, thus saving the economy. In addition, QE can lower the yield of safe government-issued treasury bonds. Treasury bonds are considered risk-free assets, meaning there's no risk that the investor will lose their principal. In other words, investors that hold the bond until maturity are guaranteed their initial investment. So by lowering the return of this safe asset on purpose, the government is encouraging investors to look for riskier investments. Riskier investments also give you higher return, such as stocks and ETFs. Finally, these QE programs aren't intended to be permanent. QE programs lead to inflation, which means every dollar becomes less valuable. You used to spend $1 for a hamburger, now it would cost you $3. The Fed typically believes an annual rate of 2% inflation is considered to be healthy. At this slow and steady inflation rate, it is good for the economy and it keeps businesses profitable. But when the inflation goes too far, it will lead to major problems. That's why when the economy is back on its track, the government is going to slowly pull out their QE programs, which means to start buying less and less and eventually stop buying these assets from banks. And of course, banks will eventually run out of bonds to sell, and no matter what, the government will have to stop buying bonds from the banks. But if you suddenly stop buying these bonds, it will cause turbulence in the market. So one way is to gradually buy less and less of these bonds from the open market. This is called tapering. Again, tapering in the financial world means the Fed is slowing down on buying assets, mostly long-term treasury securities and government-guaranteed mortgage-backed securities from banks. They are slowing down their stimulus programs. According to Reuters, on August 9th, two Federal Reserve officials said that the US economy is growing rapidly and that while the labor market still has room for improvement, inflation is already at a level that could satisfy one leg of a key test for the beginning of interest rate hikes. And Atlanta Federal Reserve Bank President Raphael Bostic said he is eyeing the fourth quarter for the start of a bond purchase taper, but is open to an even earlier start if the job market keeps up its recent torrid pace of improvement. Moreover, he and Richmond Fed President Tom Barkin both said they believe inflation has already achieved the Fed's 2% threshold, according to their separate assessments. In addition, on August 31st, according to Barron's, Federal Reserve Chairman Jerome Powell, speaking last week at the central bank's annual symposium in Jackson Hole, Wyoming, said the Fed is considering a plan that would begin a gradual wind down of $120 billion in purchases monthly of Treasury securities and mortgage-backed securities, perhaps as soon as this fall. Both articles indicate that tapering is near, and as I mentioned earlier, QE programs aren't permanent. We don't know exactly when tapering will begin and how fast the Fed is going to scale back its purchases. But according to Christine Armstrong, an executive director for wealth management at Armstrong Group at Morgan Stanley, she said tapering may start as early as September, sooner than most economic analysts expect, potentially leading to a stock market decline of 10% to 15%. Here you go. That's what all the fuss is about with tapering. And that's what you should watch out for if you are an investor, because this tapering might affect all of us who invest in the market. In 2013, tapering caused spikes in volatility in the stock market, and we call that a taper tantrum. Basically, after Ben Bernanke's announcement of tapering in 2013, the S&P 500 pulled back almost 6%, and the US 10-year Treasury yield rates jumped from around 1.6% to 2.8%. That's more than 1 percentage point of the safest asset in the US investment market. S&P 500 dipped 6%. Though it was temporary, we still need to maximize our profits and avoid any potential losses if we can. If taper tantrum repeats itself, long-term investors shouldn't worry too much, but this time it might be different. It could be worse because COVID has not completely been eradicated. It could be better because businesses and the economy are back on track. According to the National Conference of State Legislatures, all 50 states and the district had a jobless rate decreases from a year earlier. The national unemployment rate, 5.4%, declined by 0.5 percentage point over the month and was 4.8 points lower than in July 2020. The economy added 943,000 jobs in July. This is great news for all of us. However, we still need to pay close attention to how the markets react when tapering begins. Of course, the Fed doesn't want the taper tantrum of 2013 to repeat itself. One good thing so far is that the Fed is giving out clues that tapering is coming, and they want the public know as early as possible. So when it is really announced, investors aren't surprised. Right now, as of September 1st, there haven't been any dramatic reactions, but no one knows for sure how markets could really react when tapering actually begins. But there are a few things we can look out for, and it's always a good idea to be prepared. Historical data shows that when the Fed is slowly pulling out their money from stimulus programs, the interest rates rise. That means higher volatility in bonds. And if you feel that a taper tantrum is coming, your bond prices will drop, and you might want to pull out of your bonds and buy the newer issued bonds with higher yield. I think if you are thinking about investing in long-term bonds right now, perhaps you should wait and see how the markets react. I don't think the interest rates could go any lower at the moment. So the best strategy for longer-term bonds is to wait, because this could prevent you from locking yourself into lower yields. And if the interest rates rise, it will be better to invest in those higher rates. In addition, remember that Fed tapering happens because the Fed thinks the economy is back on its track and growing. So international stocks, industrials, and basic materials may all benefit. In May 2013, the best performing sector were materials and industrials. And this time, I think they will even be more prepared because of the recently passed $1.2 trillion Infrastructure Investment and Jobs Act. Finally, since there will be less Fed money in the market, that could cause problems for companies that are tight on cash. So us investors should look for companies that are rich in cash and efficient with their capital deployment. UPS, Deere, and 3M are three stocks that I think will be resilient during tapering. In conclusion, QE is central banks providing liquidity to financial markets and encouraging borrowing and spending. Tapering is slowly stopping that plan and eventually stop buying altogether. If you find this video helpful, please like and subscribe. This is Grant. Trade and invest responsibly.